Welcome to this class where I want to address one of the most important areas in financial management, the goal of a firm. And I'm addressing this from a purely financial management perspective because people in other disciplines may consider the goal of a firm differently. But from a financial management perspective, there are two primary financial goals, and one of them is profit maximization, and the other one is shareholder value maximization. Profit maximization simply argues that a business exists to maximize profits for the benefit of the shareholders. It has very deep roots in microeconomic theory that managers should direct their efforts towards areas of attractive profit potential. And to know which are those areas of attractive profit potential, the managers will look at market prices to give them the signals. They will put their efforts towards those areas which will increase profits and avoid those profit-reducing activities. That is the brief summary of profit maximization, although we will look at it into some more details in a few minutes. Now, shareholder value maximization simply argues that a business exists to maximize its long-term value for the benefit of the providers of capital. The providers of capital, of course, are largely the shareholders. And value maximization seeks to address some of the fundamental weaknesses that profit maximization tends to ignore. For example, risk and timing of the earnings and inability of profit maximization to take into account what we call qualitative information. But let's address each of these goals into some bit of details, beginning from profit maximization. Now, as I argued earlier in this class, the microeconomic theory of a firm is founded on profit maximization as the principal decision criterion. And what that means is that managers of firms direct their efforts towards areas of attractive profit potential using market prices as their signals. And what we mean by that is that they will take choices and actions that increase the firm's profits, and they will avoid those choices and actions that will decrease the firm's profits. The whole idea is to achieve what you are calling resource efficiency. And to achieve this, to maximize profits, we must achieve resource efficiency, which means we maximize output for a given set of scarce resources. Or equivalently, we minimize the cost of producing a given output. If you, for example, you go to a company that is baking bread, what you're saying is that they will either get the maximum number of loaves of bread from a particular quantity of flour and associated ingredients, or rather they will minimize the cost of producing that one given loaf of bread. That is the summary of what you are calling resource efficiency. And historically, the efficiency of a business has always been determined purely on how effectively it uses resources. How does it convert resources into accounting profits? The choices that were facing managers were binary. That is, they make decisions that yield profits, and they discard completely those decisions which will not yield profits. Now, how do we apply? What limitations do we face when we are applying this profit maximization criteria in real business life? Now, profit maximization serves as a basic criterion, but it needs some deep transformation before it can provide the finance manager with what we call operational useful guidelines. In practice, it suffers some fundamental weaknesses, at least 4 of them. One of them is that it assumes away the problem of risk or uncertainty. It doesn't even consider that investors are risk averse. The second weakness is it ignores time value of money in its analysis. And the number 3 is The profit figure is ambiguous, is subjective, is not rigidly determined. Accounting processes are not in agreement on how the profit figure is measured. And lastly, profit ignores what we call qualitative information. Let's address each of those limitations in some bit of detail. We begin with uncertainty or risk. We've said earlier that profit maximization as a goal of a firm ignores risk and uncertainty. And risk in this case is the variation between expected returns and actual returns. And every investment definitely faces some level of risk. There is every possibility that the actual return will be different than the expected return. So in theory, there is a difference between theory and reality. The microeconomic theory of a firm assumes away the problem of uncertainty. When we are saying that the business will exist to maximize profit for the benefit of the shareholders, we are suggesting that we will take all decisions that will maximize profits and leave out all decisions which will decrease profits. But that is not the truth. That is not the reality. Reality is different because if we are facing risk and therefore future profits have become uncertain, that criteria of maximizing profit will lose meaning because it's not clear what are we maximizing. If those profits are uncertain, how can we maximize something that is not certain? We are not sure that we will earn it. And the reality is that investors are risk averse. Risk averse in this case, of course, means that they will want to avoid risk if there is no commensurate increase in return for that risk. When investors are faced with risk, they will ask for extra return to compensate them for an increase in risk. But profit maximization ignores that kind of reality among investors. As a matter of fact, investors rather keep their money in a risk-free asset if they realize that the risk they are facing in a particular proposed investment is very high. The second shortcoming is what you call timing of benefits. And one of the most consequential areas in financial management is what you call time value of money. The whole argument that money received today is considered to be of more value than the same amount to be received next week. And our profit maximization ignores, it doesn't take into account the timing of benefits expected from investments. That reality that if we have one investment that is giving us returns over a 5-year period and another investment giving us returns over a 3-year period, that those returns vary in timing and therefore we cannot assess their profits in the same way. Profit maximization will simply aggregate the cash flows over time and pick the alternative that gives the highest cash flows. And this will be misleading because money has time value. Money that is received earlier is better than the same amount that is to be received sometimes in the future. Simply because when money is received earlier, we have overcome the problem of risk and that money can be invested to even earn more money. So unless profit maximization is adjusted to account for timing of cash flows, then it suffers a fundamental weakness of ignoring what you are calling time value of money. Then the third limitation is subjectivity and ambiguity, because the measurement of the profit figure is subjective and ambiguous. There is no single universally standardized objective way of measuring profits. The selection of the various accounting methods and procedures, the choices of accounting standards and methods is subjective. To, for example, choose between one method of depreciation to another is a subjective method. To choose between one method of inventory valuation and another is a subjective process. And both of those will affect the amount of profit to be reported later on. And therefore, the results of that arbitrariness is that the profit figure produced from a given database can vary widely depending on what method was chosen. One accountant will choose a particular accounting method, another one chooses another accounting method, and from the same data, we get totally different figures of profit. So it is not logical for us to put this as a major goal of a firm if even what is being measured in a manner that is subjective and the measurement is ambiguous. And then the fourth limitation is qualitative information, that the profit figure is unresponsive to qualitative information. It doesn't respond to qualitative information. If you go back to your class of accounting, and among the accounting concepts, one of them is money measurement concept. That accounting is an information system that measures the transactions of a business in terms of money. But there are very many events in a business that cannot be measured in terms of money and yet affect that business. And therefore, the profit figure is unresponsive to such events. We are saying that many events highly relevant to the firm may not be captured by profit in the short term. For example, the death of a chief executive officer, if we have sudden geopolitical developments, if we have rapid shifts in dividend policies, these are qualitative issues that will not be captured by the profit figure, at least in the short term. And that lag or rigidity in adjusting of the profit figure to those qualitative information becomes a fundamental weakness. And as we contrast it in a few minutes, what we call the share price, which measures the wealth or the value of the company, reacts instantly. If, for example, the chief executive officer of a company dies, and this was the vision bearer of that company, the share price will adjust rapidly to incorporate the likely impact of this event long before the accounting profits are affected. So that then becomes the fourth very important limitation of profit maximization. Now, as a result of those limitations, we now consider value maximization to be the operational goal of a firm. And value maximization resolves some of those systematic challenges that are faced by profit maximization. For example, value maximization focuses on the cash flows that are generated by the business, which are then discounted by the cost of capital. This overcomes the ambiguity of measuring the profit figure through the various choices of accounting methods, which will give us different figures of profit from the same database. And of course, by applying time value of money in discounting those cash flows, we get rid of the problem of risk and time value of money in the analysis. But one other way in which the value of a business is measured is by use of what we call the market share price. The share price of a company in the market, if the company is listed on the securities exchange, that share price is the indicator of the value of the company. And that share price reflects like the universal consensus of every participant in that market on what is the value of that company. It therefore adjusts very, very fast when we have any changes that affect that company, whether it is geopolitical changes, death of the CEO, changes in dividend policy. All those things will adjust very, very fast. The share price will adjust very, very fast when we have any of those qualitative events happening. And for those reasons, therefore, we normally consider shareholder value maximization to be the contemporary goal of a firm. And the shareholder wealth, or what you call the shareholder value, is represented directly by the market value of the company's shares. So what we are saying is that when managers are hired in a business, their objective is to maximize the value of the company for the benefit of the shareholders. And just like I've said earlier, that market share price of the firm's shares represents the collective judgment of all market participants as to the value of that firm. That share price integrates the present and expected future profits. It takes into account the timing, duration, and risk of those earnings. It takes into account dividend policy of the firm and all other factors that bear on the viability and the health of that business. And management, and I'm using this term management very broadly to include all employees, they must focus on creating value for the shareholders. They judge all alternative investments, financing, and asset strategies in terms of their effect on the share prices. So instead of looking at using profit maximization to judge alternative investments, we are now judging our alternative investments on the basis of their effect on the shareholder value that is being represented by the share price of that company. So that is why we consider shareholder value maximization to be the superior goal of a firm. Thank you.